You know what's fascinating about market crashes? It's not the crash itself that destroys wealth. It's the calm period right before it, when everyone thinks they're safe, when the warning signs are flashing red, but nobody's paying attention. That's where we are right now. And I'm going to show you exactly why the next few months could redefine your financial future, whether you're prepared or not. Gold just hit historic peaks. Silver is staging a rally that's catching even seasoned traders off guard. Central banks are buying physical metal at rates we haven't seen in generations. And yet, if you turn on mainstream financial news, they're talking about everything except what's actually happening in the monetary system. They're focused on stock market noise, on quarterly earnings, on the latest tech IPO. Meanwhile, the foundation of the global financial system is shifting beneath our feet. Let me paint you a picture of what's really going on. Foreign central banks have been net buyers of gold for over a decade now, but the pace has accelerated dramatically. We're not talking about small symbolic purchases anymore. These are massive accumulation programs. China, Russia, India, Turkey, Poland, Singapore, nations that rarely agree on anything are all doing the same thing. They're converting their dollar reserves into physical gold at a pace that would have been unthinkable just a few years ago. Why? Because they see something coming. They understand that when you have a global reserve currency backed by nothing but confidence, and that confidence starts to crack, you need real assets. Not promises, not digital entries in a ledger, physical metal that's been money for 5,000 years. Now here's where it gets interesting. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been sitting at historically elevated levels. We've seen it approach 100 to 1, meaning you need nearly 100 ounces of silver to equal the value of 1 ounce of gold. Historically, that ratio has averaged much lower. During certain periods, it's been as low as 15 to 1. What does that tell us? It tells us that silver is dramatically undervalued relative to gold, and when that ratio corrects, as it always does, the move in silver is going to be explosive. But before we go further, I want to make sure you have access to something I put together. There's a free guide in the description below that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, no strings attached. Just click the link in the description and grab your copy. Trust me, you'll want this information for what's coming. Now, let's talk about what's driving this perfect storm. First, you have the supply side. Silver production has been in a structural deficit for years. We're mining less silver than we're consuming industrially. And unlike gold, which is primarily a monetary metal and gets recycled extensively, silver gets consumed. It goes into solar panels, into electronics, into medical applications, into batteries for electric vehicles. Once it's used, it's gone. The industrial demand alone is creating a supply crunch that most investors don't even realize exists. Then you layer on investment demand. When people get nervous about the financial system, about inflation, about currency debasement, they buy precious metals. And silver, being more affordable than gold on a per-ounce basis, becomes the metal of choice for everyday investors. You're seeing this play out right now. ETF inflows are surging. Retail demand for physical coins and bars is at levels that are straining the supply chain. Dealers are running low on inventory. Premiums over spot price are widening. These are all signs of a market that's tightening. But here's what most people miss. The paper market for silver, the futures contracts traded on the COMEX, the London Bullion Market Association, these markets trade far more silver on paper than actually exists in physical form. It's a fractional reserve system for precious metals. As long as everyone's content to trade paper claims, the system works. But the moment people start demanding physical delivery, the whole structure becomes unstable. And we're starting to see cracks. There have been reports of delivery delays, of premiums spiking, of certain products becoming unavailable. These aren't normal market conditions. These are the early warning signs of a system under stress. And when that stress reaches a breaking point, when the paper price and the physical price decouple, that's when you see price moves that seem impossible until they happen. Let me take you back to a moment in history that rhymes with what we're seeing today. In the late 1970s, silver went from around $5 an ounce to over $50 in a matter of months. It wasn't because of some fundamental change in industrial demand. It was because the Hunt brothers, a group of wealthy investors, started accumulating physical silver and demanding delivery. They exposed the fractional reserve nature of the market, and the price exploded. Now, I'm not saying we're going to see a Hunt Brothers scenario play out again, but I am saying that the structural dynamics are similar. You have a market where paper claims far exceed physical supply, and you have increasing demand for physical metal. The difference today is that it's not just wealthy speculators driving demand. It's central banks, it's institutional investors, it's pension funds looking for inflation hedges, it's everyday people who are waking up to the reality that their currency is being debased and they need to protect their purchasing power. That's a much broader, more sustained source of demand than anything we saw in the 70s. Now, let's talk about gold for a moment, because what happens in gold has massive implications for silver. Gold has been breaking out to new all-time highs, and it's doing so in the face of rising interest rates, which traditionally would be bearish for gold. Why is gold rallying when rates are going up? Because the market is starting to price in something bigger than short-term rate movements. It's pricing in the loss of confidence in fiat currencies. It's pricing in the geopolitical fragmentation of the global monetary system. It's pricing in the reality that we're moving away from a unipolar dollar-dominated world toward a multipolar world where gold reasserts itself as the ultimate neutral reserve asset. You're seeing this play out in real time with the BRICS nations: Brazil, Russia, India, China, South Africa, and now an expanding list of countries that want to join. They're openly discussing alternatives to the dollar for international trade. They're talking about gold-backed settlement systems. They're building infrastructure that bypasses the Western financial system. This isn't conspiracy theory. This is official policy being discussed at the highest levels of government. When you have countries representing half the world's population actively working to reduce their dependence on the dollar, that has consequences. It means the demand for dollars decreases. It means the demand for alternative stores of value increases. And gold and silver are the oldest, most trusted stores of value in human history. Here's where it gets personal. If you're sitting on retirement savings, if you have a 401k or an IRA, you need to understand that those accounts are denominated in dollars. And if the dollar loses purchasing power, your retirement loses purchasing power. It doesn't matter if your account balance goes up nominally, if the currency it's denominated in is worth less. You could have $1 million in your retirement account and still not be able to afford the lifestyle you planned for if inflation erodes that purchasing power. This is why more and more people are looking at gold IRAs. And I want to take just a moment here to mention something important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. It covers how to get physical gold into your retirement account without tax penalties, how the process works, what the benefits are. It's worth checking out if protecting your retirement from currency debasement and market volatility is something you're thinking about. No pressure, just information that could be valuable for your situation. Anyway, back to the bigger picture. Let's talk about what happens when this monetary storm actually hits. Because right now, we're in the calm. Markets are still functioning relatively normally. You can still buy and sell assets. Liquidity is still there, even if it's tighter than it used to be. But calm periods don't last forever, especially when the underlying fundamentals are this unstable. Think about what happened in 2008. For months before the crisis, there were warning signs. Subprime mortgage defaults were rising. Bear Stearns had collapsed. But the broader market kept grinding higher. People convinced themselves it was contained. And then Lehman Brothers failed, and within weeks, the entire global financial system was on the brink of collapse. The calm ended abruptly, and those who weren't prepared got crushed. The difference between 2008 and what's coming is that in 2008, the problem was private debt. Mortgages, corporate bonds, derivatives tied to real estate. The solution was for governments to step in, bail out the banks, and transfer the problem from private balance sheets to public balance sheets. And it worked, in the sense that it prevented a complete systemic collapse. But it didn't solve the underlying problem. It just moved it. Now the problem is sovereign debt, government debt, the debt of the very entities that were supposed to be the backstop in 2008. And when the backstop itself becomes the problem, there's no one left to bail out the system. That's when you get currency crises. That's when you get inflation spiraling out of control. That's when you get the kind of monetary chaos that destroys savings and reshuffles wealth on a massive scale. And here's the thing, the people in charge know this. Central bankers aren't stupid. They understand the math. They know that the debt levels are unsustainable. They know that the only way out is to inflate the debt away, which means devaluing the currency. And they're telling you this, if you know how to listen. When central banks are buying gold, they're hedging against their own currencies. They're preparing for a world where fiat money is worth less and hard assets are worth more. So what does this mean for silver specifically? Silver is the most volatile of the precious metals. It has a smaller market than gold, which means it takes less capital to move the price. When gold rallies, silver tends to rally harder. When gold corrects, silver tends to correct harder. It's a leverage play on the precious metals thesis. And right now, with silver sitting at a historically wide ratio to gold, with industrial demand creating a structural deficit, with investment demand surging, the setup for a major move higher is as good as I've seen in years. But here's what you need to understand. This isn't about trying to time the perfect entry point. This isn't about waiting for a pullback that might never come. This is about recognizing that we're in a secular bull market for precious metals, driven by forces much bigger than any individual trader or investor. This is about central bank policy, about geopolitical realignment, about the end of a monetary era that's been in place since the early 1970s. When Nixon closed the gold window in 1971, he ended the last link between the dollar and gold. He turned the dollar into a pure fiat currency, backed by nothing but the full faith and credit of the US government. And for 50 years, that system worked, because the US was the dominant economic and military power, and everyone needed dollars to buy oil, to settle international trade, to hold as reserves. But that dominance is fading. The world is changing, and the monetary system is going to change with it. We're watching the early stages of that change right now. The sanctions on Russia, the freezing of Russian central bank reserves that sent a message to every other country in the world. It said that holding dollars, holding assets in the Western financial system, comes with political risk. And countries don't like political risk when it comes to their reserves. So they're diversifying. They're buying gold. They're building alternative payment systems. They're reducing their exposure to a system they no longer fully trust. And this creates a feedback loop. The more countries move away from the dollar, the less demand there is for dollars, the more the dollar weakens, the more attractive gold and silver become. The higher the prices go, the more validation there is for the thesis, and the more people pile in. We saw this in the late 70s. We saw it again in the 2000 to 2011 period, and we're seeing it now. But this time, it's different in one crucial way. This time, it's not just about inflation. It's about the structure of the global monetary system itself. It's about whether the dollar remains the world's reserve currency or whether we move to a multipolar system with multiple reserve currencies and gold playing a central role. That's a much bigger, much longer-term shift than a simple inflation cycle. Now, I want to talk about something that doesn't get enough attention: the role of derivatives in the precious metals market. There are massive short positions in gold and silver held by commercial banks. These are hedges, in theory, against their long positions in mining stocks and physical metal. But in practice, they act as a cap on price. When gold or silver starts to rally too hard, these banks can sell futures contracts to push the price back down. It's a form of price management that's been going on for decades. But here's the problem with that strategy. It only works as long as the physical market stays calm. As long as people are content to trade paper, the banks can manage the price. But when physical demand surges, when people start demanding delivery, when the inventories at the COMEX start to drain, that's when the paper manipulation breaks down. And we're starting to see signs of that breakdown. Registered gold inventories at the COMEX, the gold that's available for delivery, have been declining. Silver inventories have been volatile, with large withdrawals followed by deposits, which suggests tightness in the physical market. These are the kinds of conditions that precede major price moves, because at some point the shorts have to cover. And when they do, when you get a short squeeze in a market as tight as silver, the price can gap higher in a way that seems irrational until you understand the mechanics. Let me give you an analogy. Imagine you're in a theater and someone yells fire. If the exits are wide and there's no real danger, people leave in an orderly fashion. But if the exits are narrow and there's actual smoke, you get a stampede. Everyone's trying to get out at the same time, and people get trampled. That's what a short squeeze looks like in a commodity market. Everyone's trying to cover their positions at the same time, and there's not enough physical metal to go around. The price spikes, and it spikes hard. We saw a preview of this in the nickel market not too long ago. A massive short position, a squeeze driven by physical demand, and the price went from around $25,000 a ton to over $100,000 a ton in a matter of days. The London Metal Exchange had to halt trading and cancel trades because the move was so extreme. Now, I'm not saying silver is going to quadruple overnight, but I am saying that the potential for a violent move higher exists, and it exists because of the structural imbalances in the market. So what should you do with this information? First, understand that this isn't financial advice. I'm not telling you to buy or sell anything. I'm giving you information, context, a framework for understanding what's happening in the precious metals market and why it matters. What you do with that information is up to you. But if you're concerned about the direction of the monetary system, if you're worried about inflation, about currency debasement, about the stability of the financial system, then having some exposure to physical gold and silver makes sense. Not as a speculation, not as a trade, but as insurance, as a hedge against the kind of monetary chaos that destroys paper wealth. And here's the key: physical metal, not ETFs, not mining stocks, not futures contracts. Physical metal that you own, that you control, that's outside the financial system. Because when the system is under stress, when there's a crisis, the things that are inside the system become vulnerable. Counterparty risk becomes real. The promise to deliver becomes less certain. But physical metal in your possession, that's an asset that can't be frozen, can't be confiscated digitally, can't disappear because of a bank failure or a brokerage collapse. Now, I know what some of you are thinking. You're thinking, this sounds extreme, this sounds like doom and gloom. And maybe it is. Maybe I'm wrong. Maybe the system muddles through. Maybe the dollar remains dominant. Maybe inflation stays under control, and none of this plays out the way I'm describing. That's possible. But ask yourself this: what's the cost of being wrong? If I'm wrong, and you own some gold and silver, you have an asset that's held its value for thousands of years. You have insurance that didn't pay out, but you still have the insurance. You're fine. But if I'm right, and you don't have any precious metals, if you're fully exposed to paper assets denominated in a currency that's losing value, then you're not fine. You're watching your purchasing power evaporate, and there's nothing you can do about it. That's the asymmetry. The downside of being prepared is minimal. The downside of not being prepared is catastrophic. And that's why more and more people, smart people, wealthy people, people who understand how the system works, are allocating a portion of their wealth to physical precious metals. Let me tell you about a conversation I had with a financial advisor recently. This is someone who manages money for high net worth clients, people with millions of dollars in investable assets. And he told me that for the first time in his career, his clients are asking about gold, not as a small speculative position, but as a core holding, 10%, 15%, even 20% of their portfolios. These are people who've made their money in stocks, in real estate, in businesses, and they're looking at the macro environment and deciding that they need protection. Why? Because they understand that wealth isn't about how many dollars you have. It's about what those dollars can buy. It's about purchasing power. And when you have a central bank that's committed to inflating away debt, when you have a government running trillion-dollar deficits as far as the eye can see, when you have a global monetary system that's fragmenting, the purchasing power of the dollar is at risk. And if you're wealthy, if you have something to protect, you take that risk seriously. But here's the thing: you don't have to be wealthy to take this seriously. You don't need millions of dollars to buy an ounce of silver. You don't need a massive portfolio to allocate a portion to precious metals. This is something that's accessible to anyone who understands the risks and wants to take action. And the time to take action is now. Not because I'm trying to create urgency for the sake of it, but because the conditions that drive precious metals higher are already in place. The central bank buying, the geopolitical fragmentation, the supply deficits, the investment demand. These aren't things that might happen. These are things that are happening right now. The calm before the storm isn't going to last forever. Think about what happens when the storm actually hits, when inflation accelerates, when currency crises start popping up in emerging markets and then spread to developed markets, when people lose confidence in the financial system. At that point, everyone's going to want precious metals, and the price is going to reflect that demand. You're not going to be able to buy silver at these levels. You're not going to be able to buy gold at these levels. The opportunity to position yourself before the crowd realizes what's happening, that opportunity exists right now, but it won't exist forever. I want to close with this. We're living through a historic moment. The monetary system that's been in place for 50 years is breaking down. The assumptions that guided investment strategy for decades are being challenged. The rules are changing. And in times of change, there's risk, but there's also opportunity. The opportunity to protect what you have, to preserve your purchasing power, to position yourself for a world where hard assets matter more than paper promises. Gold and silver aren't just metals. They're money. They've been money for 5,000 years. And they'll be money long after the current crop of fiat currencies have been inflated into irrelevance. That's not pessimism. That's history. That's reality. And the people who understand that reality, who act on it, who take steps to protect themselves, those are the people who are going to come out of this monetary storm in a position of strength. So here's what I want you to do. If you've watched this far, if this information resonates with you, if you're thinking about how to protect your wealth in an uncertain world, go check out that free guide in the description. It's got everything you need to know about protecting your hard-earned savings. And here's the thing, if you're an American retiree with at least $100,000 in any retirement account, you'll also get access to an exclusive one-on-one educational web conference completely free, no obligation. Just mention you watched this video. This is only available to people who've made it this far, who understand what's at stake. The calm before the monetary storm is ending. The question is, will you be ready when it does?